Welcome to Inside India. I'm JP Ong, and here are your headlines. Investors seeming to shrug off the shutdown drama in Washington, with Asian markets in the green tracking gains on Wall Street. LG Electronics has big plans for India, looking to make the South Asian country its global manufacturing hub as it prepares to launch its long-awaited IPO there next week. India's major car makers feeling the festive cheer and a GST boost, with many finally snapping a 4-month losing streak. And the RBI looks to boost the rupee's international standing with plans for cross-border transactions. Good morning and welcome to the show. We start off once again with a look at how Asian markets are trading today. The U.S. government has shut down, but major Asian indices are saying meh, and it seems they're shrugging their shoulders right now, shrugging off the possible uncertainties brought about by that government shutdown and continue to find room to rise. Take a look at the Nikkei 225 now, up by about 0.3% out in Tokyo, while we're also seeing a pretty strong showing actually for the South Korean Kospi, a 2.9% intraday surge this Thursday. Now, mind you, there are a couple of major markets that are offline today, among them mainland Chinese markets, which continue to observe that week-long Golden Week holiday, while the Hang Seng today is still trading, though, in Hong Kong, up by about 1.5%. And mind you, Indian markets also offline because of two holidays that will keep traders at home right now and perhaps resting instead of looking for action. And thus, you have those two major markets, the mainland Chinese markets and Indian markets, shut for the holidays. The U.S. government, though, has been shut for about 22 hours now and will likely stay shut until at least Friday. Some senators are going on leave, it seems, and won't be able to take part in a vote. The White House already, meanwhile, ramping up the pressure on the Democratic Party, warning lawmakers that if they don't push the current funding bill through, there will be sweeping layoffs across the government. And the all-important non-farm payrolls data will not be released either on Friday. G7 nations are also raising the heat on Moscow. The group's finance ministers say they plan to target nations who continue to buy Russian oil. These include measures such as tariffs and trade bans to reduce Russian funds and Moscow's capabilities to continue its invasion of Ukraine. The group also planning to phase out the remaining Russian imports as well. The joint statement comes after U.S. President Donald Trump urged allies to impose tariffs on Russian oil purchasers such as India and China. Now, as you mentioned, Indian markets are closed today for Gandhi's birthday and Vijay Dashmi, but we're gearing up for an IPO rush this month with big listings lined up. LG Electronics finally filing for an IPO in Mumbai and looking to make India its global manufacturing hub. The consumer electronics maker plans to open another factory in the country. CNBC TV 18's Hormaz Fatakia has more on this and the IPO frenzy.
The rush of IPOs continues in the Indian markets, and come next week there will be 3 IPOs worth $4 billion that will be vying for investor attention, and 2 of them will be the largest or among the largest IPOs of India in 2025. I'm talking about Tata Capital and LG Electronics, and LG Electronics will be a $1.3 billion IPO while Tata Capital will be a $1.7 billion IPO. Now, LG Electronics, which opens for subscription next week, it will see a complete offer for sale where the South Korean parent will be selling stake in the company, and which means that the Indian entity will not receive any of these IPO proceeds. They will go directly to the South Korean parent. Now, post the IPO, the stake of the South Korean parent will come down to 85%. Among the risk factors that LG Electronics has highlighted in its prospectus include the likes of a potential increase in royalty payments to the parent company, the intense competition in the Indian consumer durables market, and of course the dependent on one specific third-party provider for their services business to transport goods and services as well. Now, Tata Capital is a $1.7 billion IPO. It is a combination of both a fresh issue and an offer for sale. The fresh issue is worth nearly $800 million. The offer for sale component is worth nearly $1 billion. And the promoter, Tata Sons, and the International Finance Corporation will be selling shares in this IPO process. Now, there has been an absolute rush to hit the primary markets in India, particularly in the month of September. We have had close to 75 IPOs so far this year, and 1/3 of them have come in the month of September itself. It's not as if the market sentiment has been any better. We just concluded the September quarter, and the benchmark Nifty 50 was down 3%, and despite that, as many as 50 IPOs hit the market during this period, but most of them were priced $50 million or less. That is the kind of rush that we are seeing, and most of those IPOs are still trading below their issue price. Now, if you take a look at some of the upcoming IPOs, WeWork India is one of them, Hero FinCorp is one of them, Prestige Hospitality is also an upcoming IPO. So the rush of IPOs continues. We have raised almost $11 billion already in 2025 through the IPOs, and the pipeline promises to be yet another long one going into the fourth quarter as well.
From IPOs to manufacturing, a private gauge shows India's manufacturing engine downshifted a gear just last month. The latest HSBC manufacturing PMI fell to 57.7 in September, its slowest pace in about 4 months, as new orders and output moderated amidst tougher competition. And the U.S. tariffs may be starting to bite as well. Factories are now hiking prices at the fastest rate in nearly 12 years to offset rising input costs. Hiring also slowed to its weakest level in a year, with only 2% of companies adding staff. But there is a silver lining. Export orders are picking up, and business optimism has hit a 7-month high thanks to tax cuts and expectations of stronger demand ahead. Now, those tax cuts are also helping car makers bounce back, the auto market accelerating amid the festive rush in India. 3 of the country's 4 biggest car makers, Tata Motors, Hyundai, and Mahindra, reported year-on-year sales gains in September, breaking a 4-month decline. Tata led the pack with a 47% surge, driven by record sales of its Nexon SUV. Hyundai and Mahindra each gained about 10%, with Mahindra sales jumping 60% after tax cuts kicked in on September 22. The only laggard, market leader Maruti Suzuki, which saw sales fall 8% at its SUV portfolio, continues to struggle. Meanwhile, the RBI governor also mentioned the tax cuts during his policy address, affirming that the streamlining of these reforms would cushion some of the hit from external headwinds. The Reserve Bank of India kept its policy rates unchanged yesterday, but hinted at a cut as soon as December. The central bank said cooling inflation had created policy space to support growth, but warned of a hit to growth from tariff-related developments.
The MPC observed that the overall inflation outlook has turned even more benign in the last few months due to a sharp decline in food prices and the rationalization of GST rates. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth.
Now let's take a look at how the Indian rupee might be reacting to the RBI's decision just the other day. And we're seeing that the Indian rupee softer once more against the greenback. 88.70 is where it sits. Keep in mind the record low for the Indian rupee is about 88.83 or to 88 actually, which they actually tested just in recent memory. So again, the Indian rupee still on a weakening bias right now. But perhaps the decision from the RBI to hold off at least for now with regards to rate cuts might be giving them some room to steady. However, there is a hint at possible easing down the line, which might mean more softness for that currency in the weeks to come. And once again, 88.71 is where the Indian rupee now sits against the greenback. Asta Gudwani is the Indian chief economist at Barclays and joins us now to help us make sense of the RBI's policy decision and help us unpack the many things that RBI Governor Sanjay Malhotra actually laid out. Asta, thank you so much for joining us today. Barclays flagged the possibility of a rate cut that ultimately did not materialize. Do you think the RBI this time around made the right call ultimately to hold off on rate cuts now rather than later?
Thank you very much. Good morning, everyone. So yes, you are right, JP. We were calling for a rate cut yesterday, and we were not in luck. But it was indeed a very close call. So when we were penciling down our thoughts before the policy, it did weigh on our minds whether the RBI would like to wait to see the GST impact play out in the economy and get some more clarity on how the tariff discussions are headed. I think they did choose to patiently wait to see how some of these things will materialize. before they would deliver the other cut. Now we think that they have clearly paved the way for a December cut, and we are looking at the RBI Monetary Policy Committee cutting rates by 25 basis points in the upcoming 5th December policy.
Do you think that perhaps there is a case that some are advocating that the RBI maybe should cut rates sooner to head off any potential uncertainties? Or do you think it's more prudent actually to see them manifest and in a more material fashion before they actually act? I mean, where do you sit with regards to what's the more prudent action amidst all this uncertainty? Letting it play out first or actually heading off at the pass?
Great question. And as I just explained, that there was a solid need for the RBI to deliver a cut yesterday. And the reason that we had argued for a cut yesterday itself was to give a double booster shot to the economy. The fiscal has indeed done the heavy lifting by announcing the GST rate rationalization and many other simplification processes. And had the RBI cut rates yesterday, it would have been a very timely response to support festive demand that Indians will now start to embark upon. That said, I think RBI waited to probably sequence it better. And the two reasons that they gave for not cutting yesterday and only opening the door wide open for forthcoming easing is that they want to see the fiscal measures play out and they want to see the front-loaded cuts play out. We were hoping that they would have cut yesterday, but maybe they thought it's better to wait out.
So perhaps just opening the door wider, but you can't come in until December at least. One thing they did, though, Ashta, is that they decided to actually loosen restrictions on bank lendings for acquisitions and also increasing the amount of capital banks can actually devote towards supporting IPOs. In some ways, it's a loosening or liberalizing at least of funds that can go into the market systems and into the markets in India. In some ways, is this another way where the RBI perhaps is choosing to support the economy, not through cutting rates specifically, but actually just making sure that the rules are looser, at least for banks, to provide more capital either through supporting acquisitions or through supporting market activity right now?
Absolutely. So, JP, in the way that we are looking at things, I think great action yesterday was the sidekick. It were these 22 measures that the RBI governor announced closer towards concluding the policy that tried to cover a variety of aspects. And I would like to take this point and explain that we may not want to call them looser. We may want to call them more pragmatic because they are better curated to the capital structure needs of the day. So we are acclimatized and we are very familiar with large exposure framework, with the overlaps between banks and NBFCs, with banks not being allowed to do M&A financing. And we thought those were the best practices to do at a particular point in time. With capital structures now evolving, financial markets becoming more developed and more mature, data becoming available on all sorts of things, I think the RBI made a very pragmatic approach in trying to ease out some of these measures which will support doing business in India, which will support bank credit in India, NBFC credit in India. And some of these policies were in a way restrictive and were not exactly suited to the current funding demands of the economy, especially from large corporates or for banks which had NBFCs that had overlapping lines of businesses. So I think ease of doing business, improving the flow of credit, of course, giving some support to exporters and importers in this dire time, nationalization of rupee, and policies on how to strengthen the financial institution structure in general were at the heart of these 22 measures. So while we were not exactly kicked about RBI not cutting rates yesterday, I think these 22 measures made it look like a mini budget for India, so to say.
So pragmatic, not looser. I stand corrected there. When you look at the measures right now to support the economy through that, and you combine that with the GST cuts, actually, in some ways, is this a way of betting on India's internal ability to sustain growth amidst all of these externalities right now? Basically a bet on the Indian consumer and also a bet on Indian business optimism to sort of insulate or to sort of guide the economy through some of these rougher patches that's really hitting most of the world at varying degrees.
So India is a domestic-oriented economy. 60% of our GDP comes from private demand. External demand is an important factor for India, but it is significantly lower in its contribution as far as our gross domestic product is concerned. At a time where many countries in the world are feeling hostage to geoeconomic fragmentation and the tough trade and tariff policies, India is, of course, at a relatively more disadvantageous position given the kind of tariffs that we are witnessing. In that light, coming out with policies which strengthen domestic demand, which strengthen the capabilities to lend to the corporate sector so that we can reignite private investment, are absolutely the right thing to do. So our strength lies in domestic consumption and private investment. And I think the kind of measures that you have seen coming from both the government and the Reserve Bank of India in terms of providing consumption support through GST rate rationalization and providing investment support by allowing banks with healthy balance sheets to start lending for many of the activities that they were previously wary of, are the right messages to be given to ensure that growth story stays intact. And I would like to draw your attention to the upward revision of the growth forecast that the Reserve Bank of India did yesterday. They now look at growth coming in at 6.8% in financial year 26, up from 6.5% last year. Although it has peaked with the last print coming in at 7.8, but I think we will be surprised to see how few our global economies right now clocking in a 6.8% growth rate.
A 6.8% is the new forecast. Is that more or less in line with what Barclays is also expecting right now?
So we have a 6.5% ourselves. We were never in a rush to cut our growth forecast when the tariffs were announced and did not reverse that trajectory either. We are quite watchful of the incoming GDP new release that will take place in February 2026. That's when the new revised base will come in, and we wait to look out for that before we take any further revision.
I'm curious though, Ashta, because one thing that was also noted is that while 6.8% is a higher expectation, the goal still is to try to get to growth rates within the ballpark of 8% to support India's goals to try to become a developed nation sooner rather than later. But this is something that a number of other countries in Asia, like Indonesia, for instance, are trying to get to. But is 8% perhaps a little too much to actually reach for? And I think the reason I'm asking also is that if you start to push for growth rates that are a little bit too fast, there is a concern that of a possible overheating of the economy. Do you think that applies in India's context, or do you think 8% is actually something that's achievable for the country?
It was not too very long ago that we clocked in a 9.2% real GDP growth rate. That was financial year 23. So I think achieving 8% should not look unimaginable in times like these. Of course, the world situation that we were living in 2 years ago versus now is very different because of the trade and tariff situation, and that is a drag on India's growth. That said, India aspires to become a developed country by 2047, and MAC suggests that growing at 8% will be the trajectory, or is the trajectory that is needed to become one. It is neither unimaginable nor unachievable, and I think the policy push that we are seeing from both the government and the RBI is pretty much in tandem to ensure that that dream becomes true one day.
Okay, Ashta, one thing that was flagged by the RBI governor also is tariffs, because again, it's not we're not completely devoid of possible headwinds. In fact, he said it might start to manifest in the second half of the fiscal year. The other thing we also noted was that when we looked at the PMI figures, while it did dip a little bit, it's still looking quite strong above 57. But they did note that input costs for factories are rising, and they linked that actually to some of the tariffs. Can you help us understand why the tariffs that have been imposed over the last 6 months by the U.S., why that's impacting the cost of inputs for factories in India? Because from my understanding, it really is going to impact more inputs that are brought into the United States and not really tariffs that are being imposed on inputs going into India. Why is it that the tariffs seem to be pushing up factory costs in India right now?
Right. So I think there are conflicting signals coming in from the input cost index of PMI and the wholesale price index that we track in India for factory gate prices. As you would know, the last print of WPI inflation in India was a very low 0.5%. And it is only because of base effects that we will start to see WPI inflation inch up. There is a conversation of cheap inputs being dumped into India from China already. I would be surprised to see input costs rise meaningfully and steadily from here on. My understanding would be that the current increase in input costs, especially in the PMI, could be a one-off and could be related to factors which aren't to do much with raw material costs or commodity inputs. In sum, the global commodity prices, because of global growth slowdown and because of dumping risks from China staying elevated, are well contained and actually falling further. and that translates into a meaningful WPI deflation or disinflation tailwind for India, which we expect to continue.
All right. Okay, let's go back, Ashta, to some of the reforms or some of the new measures that was introduced by the RBI that made the policy decision a bit of a sidekick, as you mentioned a while ago. And that's really trying to promote the use of the rupee and using rupee-denominated loans in some of India's neighbors, such as Sri Lanka and Nepal, among others. What does this mean for, with regards to the Indian economy? Does the broadening or the growing acceptance, or say the rupeeification, if I can call it that, of loans internationally, does that actually translate into any support or help for the economy at all?
So apart from the internationalization of rupee, where there has been a conversation to allow lending in INR in some of the neighboring economies, there was also a reform, or there was also a measure to allow the special rupee Vostro account holders to deploy their funds in commercial papers and certificate of deposits, expanding this from the government securities and T-bills previously. My understanding is that this particular measure is more linked to internationalization of INR than or will be more immediately effective in supporting internationalization of INR than the transparency that we have given the ADs or the easing in the lending that we are going to do to some other neighboring economies. But taking a step back, I think, JP, at the heart of things here is to make sure that INR becomes a more widely acceptable currency. We have seen bilateral trade settlements in INR with trading partners improve. We have seen Vostro account holders deploy some of their funds in government bonds, and that will give them the kicker instead of letting that money stay idle. And I think expanding that to more debt instruments, which are more return accretive in nature, will also step up the acceptance of INR in bilateral international trade. Those would be my thoughts on internationalization. But I must take your viewers' attention to some of the ease of doing business announcements that the Reserve Bank did yesterday, of which of prominence are allowing banks to now fund mergers and acquisitions, making sure that the large corporates which have more than 100 billion INR exposure continue to have access to bank funding, allowing banks with overlapping lines of business with their own NBFCs to continue to borrow. And I think these will go a long way in unlocking the bank credit growth potential that we would like to see, that will finally help the private investment cycle come on board.
And just very quickly, Astha, does Barclays have a year-end outlook for the rupee, which, as we mentioned, has tested record lows on more than one occasion recently? What's the outlook right now for the end of the year with regards to the currency?
Right. So we are by June next year, we are looking at INR at 90. We are looking at a very steady depreciation from here on. We do have a call for dollar to weaken further, but any reason for INR to actively and sporadically depreciate from here on is limited.
All right, so 90 by June of 2026. Asa Gudvani from Barclays, thank you so much for joining us here on Inside India to help us unpack the many decisions made by the Reserve Bank in India at its policy statement just the other day. Well, more news and updates coming up on the other side of the break, but do stay tuned and don't go away because you are watching Inside India. Welcome back. You're watching Inside India, and here's some of the stories we're keeping tabs on. India's trade pact with Switzerland, Norway, Iceland, and Liechtenstein came into force on October 1st. The four nations will drop tariffs on over 90% of Indian exports, boosting textiles, leather, and food products. New Delhi will offer limited concessions, but has protected sensitive sectors like dairy and coal. The deal also targets $100 billion of investment and 1 million jobs over 15 years. India has approved a pay hike for federal government employees. A 3% hike is set to benefit nearly 5 million government employees and 7 million pensioners. The decision comes just days after the country reduced taxes on various household goods. The pay hike is expected to further spur consumption as Indians ready themselves for the festive season. And the Indian government has approved a nearly $10 billion budget to support prices for winter crops. The move will apply to the 2026 to 2027 marketing season and is aimed at ensuring farmers receive fair prices for their harvests. India's Minister Ashwini Vaishnaw says procurement during the winter season is expected to reach nearly 3 million metric tons. Well, coming up, we'll head to the crypto event in Singapore, Token 2049, with my colleague Elaine Yu. She's standing by with Binance's head of institutional and VIP, Catherine Chen. That conversation is coming up next. Don't go away. Welcome back to Inside India. Let's take a quick check now of cryptocurrencies. It's looking like a good Thursday, actually, for a lot of the coins today and a lot of tokens. You're seeing Bitcoin today finding room to rise even further, up by about 1.3%. Ether looking quite solid also with a 1.5% intraday gain, and there is nothing light about Litecoin so far this Thursday. They're surging up by more than 6%, and a lot of optimism returning to cryptocurrencies, and perhaps also because some of the conversations we're hearing out at Token 2049. In fact, let's head out to Token 2049 here in Singapore, where crypto leaders from across the world have gathered. In fact, Elaine Yu is on the ground with a very special guest. Elaine, take it away.
Good morning, JP. So one big theme we're talking about at this conference is institutional adoption, which has been making crypto more and more mainstream. And we're seeing the world of traditional finance and DeFi coming together. And there are lots of possibilities when these two worlds collide, but also some challenges and questions when you bring highly regulated markets to what's been called the Wild West of crypto. And joining me now is Catherine Chan, head of VIP and institutional at Binance. Thank you for joining us today.
Thank you for having me.
So I want to talk about institutional adoption, something to start with you on. Are you seeing new institutional investors, including maybe more mainstream ones, coming into the space, and where are they putting their money?
No, yes, absolutely. So it's actually an ongoing trend. In the past couple of years, we have seen a gradual ramp up of institutional moving into the industry. And last year with the introduction of ETF, and this year with all the digital asset treasury, we're definitely seeing that, number one, crypto is getting the legitimacy it needs as a emerging asset class. And also for a lot of the institutional investors who were previously on the sideline, not sure what was their entry point, to now having a much easier access as a first step of exposure into the asset class. So this year especially, we are seeing even broader demographic when it comes to institutional type of investor. Historically, we have a lot more of the trading focused institution, whereas this year we see an increase of corporates, family offices. So it's really much more diverse, and some of the medium to long-term holding strategy company. So that's, you know, the institutional investment scene has been quite interesting in the industry this year.
Yeah, and for the newer players here, the family offices, the more mainstream investors, are they starting with the more simple products, the instruments there, or are they taking some risk with the newer products, seeking to gain more exposure to crypto? What are the trends there?
So it really is a combination, and at the end of the day, it depends on the risk appetite and how comfortable a family office is in terms of dabbling into the asset class. It is true that for a lot of them, they're probably starting with the instrument, the wrapper that they're most used to, which is the like of ETF or the DAT, which is essentially listed equity. And on top of that, many of the family offices, we know that in wealth space, people are quite familiar and comfortable with structured product. So that is obviously another way that people are essentially gaining and increasing their exposure into the asset class. However, at the same time, we also see some family offices who are basically, they want to be a few steps ahead and basically, you know, take a deeper dive into the industry, looking beyond the top few coins, and so it's really a combination, and really depends on the risk appetite of the particular family office and the institutional investor.
Yeah, and I want to ask about DAT since you brought them up. What do you think of this model essentially? Because during good times and bull markets, that's a good way to capture the upside, but there are perhaps risks too when we see market downturns. So what are some mitigating strategies with these volatile, crypto prices that are now being used as treasuries?
So again, in the end, it's the same, because the underlying asset is the same. It is digital asset, and this is it goes along the same line as what we have always educated our investor: do your own due diligence. So again, of course, we understand that for many of the traditional investor, DAT, because it's in a wrapper, it's essentially listed equities, that is an easier accessible wrapper instrument for institutional investor. However, the underlying asset, number one, obviously do proper due diligence on the underlying asset, and number two, obviously look into the setup of the corporate treasury itself to ensure that you are gaining the right exposure of the underlying asset, right? What you obviously don't want is to invest in a DAT that is essentially not a Delta 1 exposure of the underlying asset. So really, again, in the end, and this is what all the institutional investors are supposed to be best at, which is do plenty of due diligence to ensure that they're not going into this blind. And so that's what we would really say.
And we talked a bit about the worlds colliding: TradFi, crypto, decentralized finance. So how do you see Binance? How does it balance sort of becoming more institution-facing? Maybe some of these managers have stricter mandates, with also catering to the DeFi crowd. That's a very different class of investors.
So here at Binance, as a centralized exchange, we always pride ourselves to be at the forefront of platform, product, innovation, and of course, Binance right now, being having the most registration and in multiple jurisdictions across the world, compliance is obviously something that is very, very important to institutional players around the world. Now, while DeFi is emerging and there's a lot of hype around it, it is not necessarily a marketplace whereby institutional investors are comfortable or is even allowed to participate in, right? So on our side, obviously, what we do is we continue to innovate and ensure that we have the institutional grade infrastructure for the player who can, who really feel much more comfortable operating in, number one, a compliant environment, and number two, just a place whereby there is much more developed institutional infrastructure. So that for us has been a huge focus, and we are definitely seeing it pay off in this wave of institutional adoption.
And also, at Token here, the atmosphere, right? We're getting a lot of exuberance with more crypto-friendly legislation in the U.S. and other regulators moving ahead as well. Is this optimism masking any hidden risks that you think we should be talking more about?
In general, I think obviously people should always be, prudent with the market risk, and this is the same across all different asset class, right? S&P probably is, has hit all new high again, so it's the same as well. Obviously, right now there's a lot of hype, and the market is warming up towards a digital asset. But however, again, what we should not forget is, again, number one, ongoing regulatory clarity and development is very important for us. For important market players such as ourselves, we genuinely try to look beyond all those hype and just continue to build our infrastructure and build and remain very, very committed to our mission, so that really what we would say is just to look beyond the hype. Market has its up and down, and has its cycle. It always happens. So again, when investing, do your due diligence, and when you are making investment, choose your investment partner carefully. So those are all the usual things that I think is especially important when the market are generally so excited. And don't be FOMO. Always do plenty of homework and make your way into the space.
And I also want to ask you about stable coins. It's also a big theme this year, of course, with the Genius Act, and we're seeing a greater number of stablecoin issuers now. How is Binance capturing the stablecoin wave?
So first of all, as there are better regulatory clarity, it is very important for us to partner up with regulated stablecoin to ensure that we are able to offer the asset in a lot of the jurisdiction around the world. That is number one. And number two, actually, for a lot of our institutional investors, they also are catching this wave, and because stablecoin itself actually does solve a number of pain points. One of the newest introduction in the industry is tokenized money market fund or yield-bearing stablecoin. Those all help our institutional investor to become even more capital efficient and also save a lot of hassle for them to ensure that the stable asset that they hold, perhaps as collateral or perhaps as part of the cash management asset, to continue to earn yield for them while they don't really need to do much, right? So all these introduction not really invention, it's really just something that becomes available now in the industry is truly, truly very important, and I think this will further accelerate institutional adoption as well.
And last question for you. You're based in the UAE, and how do you see different regulations? For example, in the US, it's moving ahead. People are excited about that. And Hong Kong is also trying to push to become a digital assets hub. Singapore, all of these jurisdictions are going for it. What do you think Asia, how is Asia doing compared to the US?
Compared to the US.
Yeah.
So again, I'm personally in UAE, and obviously the local regulator in UAE has been tremendous partner. At the same time, we work very, very closely with regulator around the world. Again, for Binance, compliance is at our core, and it is very important for us to work with the regulator to ensure that we are able to offer our product and platform in a compliant way to every local market. And in the process, obviously, there is a lot of conversation, and there's at times there is a lot of education that needs to happen as well. So for us, I definitely think that in Asia we're still engaging in a lot of conversation, and we are very, very optimistic that the global regulator are definitely taking a much closer look at the asset class and the industry, and the viewpoint is probably slightly different from, let's say, a few years ago. The industry has come a long way, so we're very optimistic where we will get to eventually.
Indeed, a space that we'll continue to watch very closely. Catherine, thanks for joining us today. That was Catherine Chan, head of VIP and institutional at Binance. And JP, it's back to you for now.
Very fascinating conversation, Elaine. Thank you so much for bringing that to us. Well, coming up, we'll take our coverage from token to Milken. The 12th edition of the Milken Asia Summit also underway here in Singapore, and we'll bring you an exciting conversation of the forum after this short break. Back in 2 minutes. Don't go away. Well, as you mentioned, let's cross over to the Milken Asia Summit, where global investors and leaders are in attendance. Sherry Kang is on the ground leading our coverage there. Sherry, we're here to talk about venture capital, and also, are there too many JPs in the world? What do you think?
Exactly. I think there are too many JPs in the world. We've got JP Ong at the SGX, and we've got JP Lee of course, SBVA. And, of course, we're talking about this VC capital fund, of course, formerly known as the SoftBank Ventures Asia. JP, it's great to have you on. How are you doing this morning?
Hey, hi. Good morning.
So some big news coming out of South Korea this morning, I must point out here. So OpenAI's Sam Altman in South Korea meeting the heavyweights, Samsung's and SK Hynix's, but he had made some time to have that sit down with you. What was the conversation? Are you guys looking at Korean startups together now?
Yes. First of all, I think it's a great opportunity for Korea. There's a massive investment going on in AI infrastructures in the U.S. and it requires a lot of chips, and I think it will create huge opportunities for the chip makers in Korea. I think it's great news. I do believe, and this is what we briefly talked about yesterday, that there are also huge opportunities in AI startups in Korea. Before the AI era, people were somehow worried about the future of startups of Korea, but with the rise of AI and all these new technologies, I think we're seeing a lot more new opportunities.
When you say a lot of AI opportunities, do you feel like the volume just massively grown and a lot of liquidity has grown since the ChatGPT moment in South Korea?
So, to be honest, in terms of quantity, I mean, I'm not talking the capital, but the number of startups that we look at has somehow gone down, but the quality of the startups that we're seeing has gone up dramatically high. And I think this is because a lot of these founders have learned how to really use AI to build a better product with a less capital and within a shorter period of time. So one good example is I ran into this company a few weeks ago who was already generating a handful of revenue, and I assume they must have at least 60, 70 people in the company. But surprisingly, they had less than 5 people. One engineer was using AI to do all the coding. One designer was doing all the design work using AI. And the rest, they're all using AI to run this operation. And that's something that would not have been possible, without the AI and before the ChatGPT days. So we're seeing and we're expecting to see more and more of these companies. And at some point, just like what Sam Altman said in the past, we're gonna start seeing a one-man unicorn.
What are some of the opportunities that you see and you talk about with your friends like Sam Altman or your mentor, should I describe it that way, Masayoshi-san, about some of the underhyped areas that sort of go beyond some of the familiar AI investing areas like data centers and chips, because you're supposed to go beyond that, right?
Right. So I think when people say AI, they only think of general large language models or AI applications. But I think there are a lot more opportunities beyond that. We look at the ecosystem, how this ecosystem is being built on top of this massive investments that goes into AI infrastructure. So, for example, with this new infrastructure, it requires a lot of network storage or energy storage system, new type of batteries, or new generation network Ethernet chip, or even like a new custom edge inference AI chip. And these are all type of business that can exist with this new era. And we're seeing a lot of startups trying to tackle these problems. And also there are going to be a lot of robots required to build this massive infrastructure. And we're also seeing a lot of interesting robotic companies that will grow along these massive investments.
I was actually talking to a guest earlier this morning from Brookfield Asset Management, and what he was saying is that basically data is the new oil that would actually power these robotics, and we don't have that yet. So people want to buy the data.
Right.
Is that what you're seeing in the VC investing as well?
That's right. So we try to break this down into three different pieces. Where there's an intelligence, we see the rest of the two pillars as one, data, and the other one, the actuator, the robot part. And the matter of fact, I think this part, data, also includes hardware technologies like sensors that can collect data. And for example, we have one company that we've been supporting that created gloves with very sophisticated sensors in it, so that it can capture the movements of humans for all these complicated tasks, and it collects all the data and it helps train the model, and the model can using these data actuate the robotic hands as if they're real human hands. For
so
these,
they'll be smoother, not so clunky.
Right, smoother and custom for very complicated tasks that people thought only humans can do. So, back to your point, we are looking for not just data companies, which is also important, but these sensor technologies that can capture these physical data in their own unique way, and then have it trained to the model, and put it back into the actual robots to make it work in the real world.
This question just hit me actually. Do you think VC investing, your job, will get disrupted by AI?
Oh yeah.
Because I'm worried about my job.
Oh yeah, I think you should be. So it is already making a lot of changes in our tasks. So one of our job is to analyze our target company. Analyze meaning we do a lot of due diligence, look at their business plan, we analyze their financial models. We also do a background check of the team. To be honest, already AI is doing a lot of their work. And for me, when I meet a new company, I do ask my ChatGPT to digest all the data. And within 2-3 seconds, I get a summary of what the company does, what's the background of the founder, and what's their kind of a market potential valuation. And the thing is, back in the days, if I were able to invest or review 2 or 3 companies a day, now I can review 20, 30 companies a day using AI.
I think all the panels are adjourned for a lunch break, so energy is picking up. But I do want to talk about this evolving relationship, perhaps, between GPs and LPs in AI investing. Because you're working with some of your LPs, like some of the South Korean conglomerates, do you think about, or are you already doing, co-investing into these AI technology companies? And what do you think that means for conglomerates down the road? What are they looking for?
I lost the first part.
So GP-LP relationship in AI investing. Do you think that it would lead to the trend of co-investing down the road?
Okay. Got it. Sorry, the crowd is really loud. I'll put it this way. We are already using our own internal system that AI is managing not just our existing portfolio companies, but our potential deals in pipeline, and they're helping with all the summarizations and process management, and we do provide this platform that we use to our LPs now, so they can actually using this platform look at what kind of companies that we're reviewing, and even what are some recent updates from our portfolio companies with the management of AI. And we also provide this platform to them to see if there are core investment opportunities that we can work together with. So this is something that we have been trying, and the response that we've been getting from our LPs were very optimistic.
JP, it's great to have you on. Thanks for being such a pro. Have fun at Milken. That was, of course, JP Lee, CEO of SPVA. JP, it's back to you.
And really the takeaway there, Sherry, always trust a JP and what they're thinking about with regards to the markets. One final check on how Asian markets now are doing, though, this Thursday morning. And we're seeing again that field of green really across many of these major equity indices. And as mentioned a while ago and hinted at a while ago, the South Korean Kospi running away with the show today, surging by 2.9%. No doubt getting a boost from the visit and the announcement of those deals regarding OpenAI. Chip makers out in Seoul, among the biggest gainers, that is, and doing much of the heavy lifting for South Korean equity markets. The Nikkei 225, no slouch either, up by about 0.7%, that is. Meanwhile, while mainland Chinese markets are offline today because of that Golden Week holiday, we are seeing the Hang Seng continue to trade today and trade quite positively and optimistically. They're up by about 1.5% out in Hong Kong. And we're also seeing gains for the TAIEX today, up by about 1.8% in Taiwan. Here in Southeast Asia and in home courts, Straits Times Index up by 1.6%. Notice once again that Indian markets are offline today because of two holidays that are keeping equity markets in check. But we are seeing that the Indian rupee is trading as well today, and we are seeing that the Indian rupee is finding a way to at least stabilize itself after days of trying to test record lows. The Indian rupee also looking quite decent. But again, we have to remember that Barclays earlier on today, Ashta Gudvani, told us that their forecast for the Indian rupee could see it weaken to as much as 90 against the US dollar by June of 2026. So that's definitely something to watch out for. More room perhaps to soften for the Indian rupee, especially because more rate cuts from the Reserve Bank of India might be expected, even though the RBI decided to hold off on cutting policy just the other day. And that's all the time we have today on Inside India. But do keep watching CNBC. Access Middle East is coming up next. Have a good morning.